Welcome to day 2 of the Passive Investing 101 Masterclass. I'm Ciaara Hoffmann, and today we'll be discussing key financial metrics that you, as a potential limited partner investor, should understand when evaluating multifamily syndication deals. If you're new to real estate investing or haven't yet dipped your toe into multifamily syndications yet, don't worry, we'll break these down into simple and easy to understand terms. So let's get started. The first term we'll discuss is cash-on-cash return. This metric measures the annual pre-tax cash flow generated by the property relative to the initial cash investment made by yourself, the investor. In other words, it shows how much cash flow an investor receives from the investment as a percentage of the amount invested. It does not include the potential profits you would make on the sale of the property. So to calculate the cash-on-cash, you'll need to calculate the annual cash flow, determine your initial cash investment, and divide the annual cash flow by the initial cash investment and multiply that by 100 to get the percentage. So for example, if you receive $8,000 a year in cash flow and your initial investment was $100,000, then your cash-on-cash return would be 8%. So cash-on-cash is a straightforward way to compare different investment opportunities and assess the cash flow performance of a multifamily syndication. Next, let's discuss the equity multiple, also known as the equity multiplier. This metric evaluates the overall return on an investment relative to the initial capital contributed by the investor. It represents the multiple of the initial equity investment that an investor expects to receive over the entire holding period of the investment. And it does include both the passive cash flow throughout the hold period, as well as the profits made upon the sale of the property. So to calculate the equity multiple, you'll need to calculate the total cash distributions, determine the initial equity investment, and divide the total cash distributions by the initial equity investment. So, for example, an equity multiple of 2.0 means that you doubled your initial investment. Keep in mind that this does not take into account the amount of time you held the property, which could have been 3, 5, or maybe even 10 years. Equity multiple is a simple way to assess the total return on an investment in a multifamily syndication. Next, let's talk about average annualized return, or AAR. You might also see this as the annual rate of return, or ARR. This metric evaluates the performance of an investment over a 1-year period. It does take into account both the annual cash flow generated by the property as well as the appreciation which would be realized upon the sale of the property. To calculate the ARR, you will need to determine the initial investment and divide the total annual return by the initial investment, multiply that by 100 to get the percentage. So, building off of our last example, if you had doubled your investment over a 5-year period, that would mean a 20% ARR. The ARR provides a useful benchmark for comparing the performance of different multifamily investment deals. Another important metric is the internal rate of return, or IRR. This metric represents the annualized rate at which an investment is expected to grow, taking into account the cash inflows and outflows over time. IRR is the interest rate at which the net present value of all cash flows becomes 0. Calculating IRR can be complex and often requires specialized financial software or spreadsheet tools to solve. However, it is an essential metric because it takes into account the time value of money and provides a comprehensive view of an investment's performance over its entire holding period. Finally, let's talk about preferred return, also known as pref for short. Pref is a financial term to describe a priority return on an investment for limited partners before the general partner or GP receives any profit distributions. In other words, it means that as a passive investor, or LP, you would get paid first before any of the general partners get paid from the passive cash flow on a property. It is a way to align the interests of the LPs and the GP by ensuring that the limited partners receive a minimum return on their capital before the GP gets a share in the profits. A preferred return is typically expressed as a percentage of the initial capital contributed by the LPs, and is paid out of the property's cash flow. It is often used as a risk mitigation tool for LPs by providing them with a degree of downside protection in case the investment underperforms. So here's how preferred return works in a multifamily syndication deal. The GP and LPs agree on a preferred return rate, which is often stated in the operating agreement or private placement memorandum, PPM. This rate is usually a fixed percentage, such as somewhere between 6% to 10%, and is calculated annually based on the LP's initial capital investment. When the property generates cash flow, the preferred return is paid out to the LPs before any remaining profits are distributed between the LPs and the GP, according to the agreed-upon profit-sharing structure. This could be a 70-30, 80-20, or another percentage split, which is in favor of the LP. If the property does not generate enough cash flow to cover the preferred return in a given period, the unpaid amount typically accrues and is paid out in future periods when there is sufficient cash flow. However, the specifics regarding the accrual of unpaid preferred returns depend on the terms of the investment agreement. In some cases, the preferred return is non-cumulative, meaning that any unpaid preferred return in a given period does not accrue and is not owed to the LPs in the future. But this structure is less common and less favorable for the LPs. Once the preferred return has been paid to the LPs, any remaining cash flow is distributed between the LPs and the GP according to the agreed-upon profit-sharing structure. It's important to note that a preferred return is not a guaranteed return, and it is subject to the property's ability to generate sufficient cash flow. However, it provides a level of assurance to the LPs that their interests are prioritized and they will receive a minimum return before the GP participates in the profits. In summary, understanding these financial metrics, cash on cash, AAR, IRR, equity multiple, and pref, is crucial for potential LP investors like you when evaluating multifamily syndication deals. By using these measurements, you can compare different investment opportunities and make informed decisions about which properties to invest in. Remember, each metric serves a specific purpose, and it's important to use them in conjunction with one another to get a comprehensive view of a real estate investment's performance. This way, you can confidently enter the world of multifamily syndications and make well-informed decisions that align with your investment goals. Thank you for joining me today, and I hope this helped to clarify some of the terms you'll come across when evaluating potential multifamily deals. If you still have questions or want to learn more about how Synergy Capital Investments can help you navigate your first investment into a multifamily syndication, feel free to schedule a call with me on my Calendly link below. There's no pressure, and my goal is simply to make sure you feel 100% confident in your decision, no matter who you decide to invest with. I'm happy to provide any support you need when evaluating your first multifamily syndication investment. Thanks for watching, and stay tuned tomorrow for Day 3 of the Passive Investing 101 Masterclass, where we will help you determine if investing in multifamily syndications is right for you. Until then, happy investing.